Folks, the markets are moving. It's summer, but the markets are moving. The other day, the stock market goes down over 700 points. Today, the stock market's up already over 300 points. Any way you look at it, it's volatility. And you know what's the best thing to do in non-directional volatility? Credit spreads. Because you don't have to worry about direction. You have to worry about where the market is not going to go. And with the volatility, premiums are juicy right now and ripe for picking. So let's get into credit spreads. I'm so excited. First off, if you don't think you're ready to try credit spreads yet, think again. I can help you do it in a blink of an eye. I have 25 years of experience in these markets as everything from an educator to professional broker and a high-end hedge fund manager. And I know what works. Click the button below now to find out more. Do it now. Folks, let me tell you a big secret. Do you know why 99.9% of you don't do credit spreads? Well, it's because you think they're hard. But they're not. They're easy. They're effortless. Let me show you what I mean. This is a real simple explanation, and you can apply this to just about any stock, ETF, even a futures contract. Here's how it works. Let's say that let's say that Amazon is trading at 1800, all right? And let's say that we believe that the 1800 is the cap, the peak, all right? The high. We believe the market's going to go lower. It's an example. Just go with me on this, okay? So what we do is we sell the 1802.50 call, and we buy, that's a sell, and we buy the 1805 call. All right? So, and let's say that the 1805 call costed 20 cents. And let's say that the 1802.50 call sold for $1. So, 20 cents, $1. You can see how good my writing is here. So, we now have a credit of 80 cents. All right? Now, our risk, and here's the cool part. Our risk, let's say Amazon goes to 1900. Our risk is the difference between these two strike prices. It's the difference between 1802.50 and 1805. That's our risk. So if Amazon goes to 1900, 2000, 2500, our risk is the difference between these two strike prices minus the premium that we received. And it's always the same, no matter what credit spread you do. So, let's say this credit spread, we took in 80 cents. We have to subtract that from $2.50. So our overall risk is only $1.60. That's our overall risk on this trade. And Amazon just has to stay below 1802.50. And let's say this option expires in 7 days. After that, it's gone. We get to keep the 80 cents. And the percentage of profitability here is over 80%. So that's a credit spread. It's really, really simple. The risk is the difference between the buy and the sell side. Your spread risk is limited to the two strike prices, the difference between the two strike prices. So if you did a 1805 call and an 1800 call, and let's say you took in $2 premium, your risk would be $3 minus $2. So your risk would be only $1. So again, your risk is the difference between the two strike prices, the one that you sell and the one that you buy, minus the premium that you take in. And then you just have to be mindful of the expiration date. And again, you have to figure out where the stock is not going to go instead of where it is going to go. And I'm going to tell you right now, it is about 100 times easier to figure out where a stock is not going to go than where it is going to go. Hope that helps. So, are you ready to learn more about how I can help you understand credit spreads and how you can start using them in your trading now? Click the button below and I'll tell you everything in my last great income trade. It's easier than you think. Don't delay. Do it now.